Good morning from London. I'm Kriti Gupta alongside Mackenzie and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. The EU delays retaliatory tariffs after President Trump threatened a 30% rate on goods from the European Union and Mexico. That is if an agreement is not reached by August 1st. Meanwhile, President Macron raising the French defense budget in a move to bolster its security, but threatening progress on reducing its fiscal deficit. We've got one eye, of course, on the bond market. Speaking of the bond market, Fed Chair Jay Powell facing a new wave of pressure from the Trump administration, this time on the renovation of the Federal Reserve's headquarters. We're going to dive into the details. Val.
Let's check in on these markets just an hour before the opening trade in Europe. We are seeing risk on a back foot, Kriti. We've got S&P futures down 0.5%. European futures underperforming this morning, down to that threat of 30% tariffs. Euro-dollar, I have to say, quite resilient, down less than 0.2%. And those U.S. 10-year yields creeping higher again. Friday was a pretty weak session for fixed income. It seems like that path is continuing. 442 on U.S. 10-year yield. The countdown to the opening trade starts right now.
So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. Right now, as you know, they're paying a substantial tariff, but they want to make a difference. So some of these deals, maybe I'll change them and maybe I won't.
Maybe he'll change it. Maybe he won't. Is the markets actually watching? Do we even care? Let's start off with the numbers here. The 30% seems to be the key figure on the EU, on Mexico as well. We've got a couple of weeks before they actually kick in, but how much pressure does it really add? We know that the European Union, let's start there, we'll go to Mexico in a moment, kind of taking it calmly. They pulled back the retaliatory tariffs. They're saying there's still negotiations. Meanwhile, France's response to this has been, let's use the anti-coercion tool. Let's dive in. Let's respond in a very big way. Brussels taking a bait. We'll see where this takes us. Yeah, the market is taking this quite well. I think there is some positivity still around a deal to be reached in the next few weeks. Eurodollar is only down 0.2%. We were speaking to an FX analyst, Sonia Martin at DB Bank. She was saying that on a 30% tariff, she'd expect euro to drop by a percentage point. So we're definitely not seeing the worst case scenario when it's playing out in the markets at the moment. And
I think Kriti points to a really important divergence in terms of the French approach and the German approach. But you had the Chancellor, Merz, saying this would hit the core of German industry, 30%, while, as you accurately point out, the French President Emmanuel Macron said we should go hard in terms of our countermeasures. So there is a split and there's a division within the EU as they continue those negotiations. In terms of the GDP impact, Yari Stern of Goldman Sachs has been outlining this for us in terms of what the potential hit could be to European growth, suggesting you could have a knock on euro area GDP by 1.2% through the end of 2026, which, of course, would be material even at a time of that fiscal spend out of Germany on defence and infrastructure. And that's just the European Union story. You have to add the Mexico piece of this as well. And I'm curious to see what that actually looks like. We're going to see the likes of maybe Diageo, maybe some of the Spanish banks potentially react to some of these moves as well. But to me, it's the auto sector that's fascinating here because we did see that show up in the Canadian tariffs. So you're basically, I'm not sure quite how it works, but a lot of these European auto companies that do have that manufacturing capability in Mexico over into the United States, how does it affect that? That's going to be one to watch as well. Yeah, and I think it's interesting to think that maybe this letter will just incite anger on the European side. Maybe they weren't expecting to see a letter. They weren't expecting to see a letter with 30% on it. Does that in some way make these negotiations a bit harder? There was a lot of positivity about the trade negotiations last week, about this coming to a fruition, this trade deal, but maybe they're just angered by the fact that Donald Trump went to send a letter with a number a lot higher than it was on that April 2nd. And that anger coming out through French President Macron, of course. But you would expect EU officials should start to expect the unexpected when it comes to these trade negotiations. Talking of geopolitics, though, or thinking about geopolitics, really key in terms of the pivot that President Trump seems to have made now in terms of the supply of military hardware and significantly Patriot missile systems to Ukraine. And look, he's framing this and packaging this clearly for the domestic audience by saying Europe will pay. This is not a cost for the US, is the way he's framing it. But it's significant in terms of how he's thinking about Vladimir Putin, the fact that the lobbying from the NATO chief, the lobbying from EU and UK allies, and, of course, his phone calls with President Putin that have not yielded any ceasefire seem to have led to a really significant pivot.
It's fascinating here that 180, because domestically there's a lot of question of who is going to be blaming or pointing the finger at the Pentagon or Pete Hegseth or the Department of Defense or whatever. That being said, to me, I think what was really shocking is that, yes, you have the support from Donald Trump. You have a lot of support from within Europe as well. Emmanuel Macron making a fairly shocking statement over the weekend, saying that he's looking to double the defense budget 2 years earlier than previously expected. It's adding about 3.5 billion euros to the French budget, at least for next year. That's currently unaccounted for. So all the progress we're hoping for on turning that deficit around, the freak out of last summer in terms of OATs, I don't know where we go from here on that.
Yeah, that could be interesting to watch to see if the bond market reacts to this, because it's not just France who's expanding their budgets for defense. It's many of these many of these NATO nations. Trump is expected to meet with the NATO chief, Mark Rutte, later today. But I think when it comes down to this big announcement, it's whether we get the shift from the White House that they're going to be sending offensive weapons to Ukraine. I mean, they've talked about wanting to be aggressive in this announcement today. Are they going to be talking about missiles that could potentially have a range to even hit Moscow? Like, what kind of offensive weapons will they be discussing today? And that will be in this statement from President Trump.
Yeah, and even members of the Biden administration were reluctant, of course, to approve those longer-range missiles. But to the point, the two things interact. The increased defence spending from France and from Germany seems to have been one of the factors that at least has smoothed out some of those tensions between European allies and the US. Trump is now convinced that Europe and NATO allies are on board with spending. He has driven that charge, of course, and previous US presidents. Now France and Germany trying to step up, and maybe that opens a window for President Trump to be able to turn around and say, we can supply more to Ukraine.
Fascinating story of defense over in Washington. Let's key in on that. More drama in Washington, this time when it comes to central banking policy. Headlines over the weekend, you renewed pressure on Jay Powell.
Yeah, renewed pressure and maybe a completely different route to put pressure on the Fed. Remember, Trump needs to find cause in order to dismiss the Fed chair. They're now narrowing in on a debate that he lied to Congress about these Fed renovations, the building renovations that are taking place, about them going over budget, now costing over $2.5 billion. There also was a letter from Russ Vought, who is the Office for Management and Budget Director under the White House, calling the renovations ostentatious. And he even went to point out direct quotes from Chair Powell that he said to Congress that he is saying was deceptive of the message that he intended to give at that statement. We also heard from two Kevins over the weekend, both of which who are known to be in the running for Fed chair. We had Kevin Warsh, the former Fed governor, calling the renovations outrageous, and then White House Economic Council member Kevin Hassett saying that the Fed has a lot to answer for when it comes to these renovations. So I guess a new front has opened up on the war against Jay Powell.
The public auditions by the two Kevins is continuing, isn't it? It's pretty fascinating. But this seems to be a really significant additional layer of pressure on Jay Powell. Is this an administration now that is coordinating and laying the groundwork for an early dismissal of the Fed chair? And that's something the Deutsche Bank's analysts, George Savaralos, have pointed out as a key risk for these markets, underappreciated by the markets. According to this note from Deutsche Bank, the potential dismissal of Jay Powell is a major and underpriced risk that could trigger a sell-off in the US dollar and in treasuries. You could see the dollar dropping between 3 and 4% in the 24 hours under that scenario, according to Deutsche Bank.
It's a fascinating one as well because, of course, we have to see if that actually changes the dial at all. We know Donald Trump said he will not fire Chair Powell, but misleading Congress, where the key words, is a completely different story. So we'll see if that case actually builds. We're going to talk about that throughout the show and what that has an effect on the markets, if it does at all. Banu Baweja, the UBS chief strategist, joins us in just a few minutes. Plus Sharon Bell, Goldman Sachs senior European equity strategist as well. Tom was just mentioning Yari Sten's GDP forecast there. We'll talk about how it translates to the equity market as well. Plus the latest on the European Union as well. Anthony Gardner, former U.S. ambassador to the EU, will be joining the program. What levers can Ursula von der Leyen pull? What levers can Washington pull? We're going to dive into those details at about 8:30 a.m. UK time. And then Keir Giles, Chatham House Senior Consulting Fellow, also will be joining the program later.
Let's take a look at the risk events on the horizon this week, get you set up for your trading week. It is a lot more economic data this week than last, to say the least. On Tuesday, we get U.S. CPI. We also get the kickoff of earnings season in the U.S. with bank earnings. Those will continue on Wednesday. We hear from the likes of J.P. Morgan, Wells Fargo, Fargo, Goldman, Bank of America. On Wednesday, we also have UK CPI. Thursday, the convening of the G20 finance ministers in South Africa. It has been reported by Reuters that the U.S. Treasury Secretary Scott Bessent will not be at those meetings, instead heading to Japan for trade negotiations. We also have U.S. retail sales for a good hint on U.S. GDP. And then Friday, UMich consumer sentiment. We'll be watching those indications for inflation expectations coming out of that print.
It's a fascinating one as well. I mean, the CPI number, will it move the dial? We don't really know. If it comes in hot, is it dismissed as a one-time thing? Is it finally that moment where the tariff inflation finally shows up? Or do we maybe have our focus on Friday on the UMich sentiment? I'm not quite sure which one is more market moving.
The expectations for some economists that Bloomberg is speaking to is that this will be the first inflation print out of the US that will reflect at least some of that tariff increase, and that ties into the repricing around the Fed come September. It was interesting, Amazon Prime Day and Target and others, of course, in the retail space in the US with those discounts, and you did see a big jump, it's 30%, I think, in terms of the jump in online sales in the US. Yeah. Headline looking strong, but you lift the surface or lift the hood, and what people are buying are kind of staples versus some of the higher priced items. So it suggests that at least consumers are holding up on one level in the US, but being a little bit more conservative in terms of where they put their money.
Yeah, and there might be some hints in this CPI figure when it comes to services inflation versus goods inflation. If you see pressure on services inflation, that could be another argument that consumer is weakening versus perhaps, those tariff-exposed sectors in the goods basket showing some sort of inflation boost. So it will be an interesting dynamic to watch this week. A lot more economic data than last week, which was fairly quiet on that front.
Data and earnings, of course, this week, along with tariff volatility likely. Here's what else you need to know this morning then. Hiring by UK businesses plunged at the fastest pace in nearly 2 years last month. That's as a survey suggests a rise in payroll taxes is having a significant impact. According to KPMG, permanent staff appointments fell while the number of available workers jumped. Meanwhile, a study by Mackenzie says UK businesses are dialing back hiring for jobs likely to be affected by AI. It says vacancies in tech and finance are seeing almost twice the decline compared to other sectors. UniCredit says it will assess the next steps on its takeover plan for Banco BPM amid doubts over whether the deal will go ahead following a ruling by an Italian court. The court struck down 2 conditions imposed by Italy on UniCredit to complete its bid. However, it left in place other requirements that CEO Andrea Ocel had previously said could halt his takeover plan. And Bitcoin has hit a new all-time high of $120,000 US. It's above that right now. Investor optimism has been on the rise since it emerged from a narrow trading range that had left skeptics wondering whether the original cryptocurrency would regain the record-breaking momentum seen at the start of the year.
A 122 handle and climbing still. Amazing. As we speak. No retracement just yet. We're going to dive into the market reaction throughout the rest of the show. Coming up on the program, though, another focus on trade as the EU and Mexico lay firmly in the tariff crosshairs. The auto sector waits for clarity. We're going to dive into the read-through. Plus, more European defense spending could be a boon for weapons makers. We're going to check in on those stocks at the opening bell. But first, markets gear up for another round of tariff negotiations. How do you prepare for August 1st? We've got the all-star lineup for you. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Welcome back. Happy Monday. Just under 45 minutes, of course, from the open here on Monday, and European futures are deteriorating, currently pointing lower by more than 0.9%, and the euro, Val, is also under pressure.
Yeah, also under pressure, under an increasing pressure, as it seems, as London walks in the door. Down around now 0.2%. It did trade nearly unchanged in the Asia session. And to me, that kind of pointed to the fact that maybe European traders are shrugging this off, thinking that the US-EU trade deal is still in the works and we can ignore that 30% number. But it does seem like stocks are taking a back foot, both in the US and in Europe. Those European futures down 0.9%. 1%. I was reading the MLive blog this morning. They think that this equity weakness could really be shrugged off by solid bank earnings yesterday. They're calling for the S&P 500 to hit new highs on those bank earnings that begin on Tuesday and roll into Wednesday. Lastly, I want to touch on what's going on in Asia, because yet again, we're having another double-digit basis point rise when it comes to JGBs. The 20-year yield now reaching the highest it's seen since 2020. 25 years since we've had a yield this high on the 20-year yield. It's going to be pressuring fixed income globally. It already is this morning.
Valerie Tytel walking us through some of those dynamics in the market. We thank you so much. Let's go right back to our top trade story, of course, which is these trade concerns and the tariff story, and maybe why the markets aren't really blinking a bigger eye than we thought. Banu Baweja all over this story. Chief strategist over at UBS Investment Bank joins us around the table. Banu, I'm looking at futures. We're down 0.6% in the States, about the same margin here in Europe. That doesn't seem like a freak out around the 30% figure. Is there a line in the sand for the tariff rate that is cost prohibitive?
So the markets right now do not care, right? Far from freaking out. So we've created a tariff fear gauge index, which really on a scale of 0 to 100 looks at companies which are most exposed to tariffs on both sides of the Atlantic, right? On a scale of 0 to 100, tariff fear right now is at 0. That's not what I would call freaking out. So the market doesn't care. The market thinks this is a negotiating position. There is some reaction in the market right now. I think this reaction would be given away. The question is whether that's the right reaction or not. And I think the markets are incorrect. It's the wrong reaction to look past these tariffs and to move on, because they will have an impact on the economy. Already going into the tariffs, the U.S. consumer is weak. Real PCE spend is down on the year, and that's got nothing to do with the tariffs. That's got everything to do with the fact that the U.S. consumer was on steroids in the last 3 years, and those steroids are now waning off in terms of fiscal policy. Now come the tariffs. When the inflation impact comes through, hits real disposable income, that's when I think the markets will begin to see this. Now, I don't know whether we're going to see this in this quarter's earnings, which begin this week. My suspicion is that you probably won't. But remember, the consumer is already weak. So I think the risk-reward to chase equities much higher, I think, is quite weak.
There's an argument around the read-through here that because of the complexity of supply chains, that full 30% or 20 or 15 or whatever may not be fully felt by the consumer and absorbed throughout the process. What is the bigger risk here? That the consumer stops spending, looks at those sneakers at the store and says, too expensive, or that some of these companies start taking more margin pressure? What's the bigger risk?
I think, given where margins are right now, both will be hit. So let's just put some numbers to this.
You have to pick one, Banu.
So I think the consumer, the DPI, the disposable income, I think that will be the greater hit. But I think margins will be hit as well. Because, again, think about where margins are. Margins in the U.S. and large parts of European companies also are sort of 95th percentile, right? 12.9% margins. And although sales expectations are not crazy, earnings expectations, not for this quarter, but going into future quarters, are very high, which means the markets are expecting margins to go from 12.9% to 14% over the next 2 years. How that doesn't get hit is beyond me, which is why I actually genuinely think, Kriti, it's both margins and CPI. So I think the consumer will get hit through a real disposable income shock through CPI, but the margins of these companies will also be hit. In fact, that's what I'm watching for this earnings season. I know the bar is quite low, right? So we're expecting the lowest earnings growth since 2023. But for consumer companies and also for the Magnificent Seven, we'd like to see whether the margins continue to hold up. Magnificent Seven companies, most people think, are not cyclical at all. That's not true. Many of these companies are very cyclical. So if the consumer is slowing down, you will have an impact on their margins and their earnings as well.
Okay, so you think there's risk to Mag 7 as well on this consumer squeeze?
At this point, I think, given where valuations on Mag 7 are, I would not be overweight Mag 7. I'd be neutral market weight on Mag 7. And I think the market itself can correct over the next 2 to 3 months. The market will wait, I think, for CPI to rise. So the key question is, at what point will the CPI hit show up because of these tariffs? I don't think this happens this week. We have June data this week. I think this does happen in July onwards. So this week, we're expecting a core CPI print of 23 basis points. That's UBS. Next month onwards, we are expecting core CPI prints of late 30s, so between 37 and 40 basis points for the next 6 months. And that will tell on consumer spending.
Okay, so the tariff impact on inflation comes out in the wash in July rather than this month. So the print that we get in August for the month of July.
Correct.
What does that do to your thinking around the Fed then? Because markets are scaling back their their pricing around
As we
September.
heard from Mary Daly earlier this morning, the Fed is very likely going to look through this because they're going to see this impact as a one-off price increase, not as a trend increase in inflation. Very similar to what you would do if you were a central banker and the oil price went up because of the Straits of Hormuz, for instance, getting blocked. It's a supply shock, right? Whereas it has a disinflationary impact in the medium term on growth. So you would worry about the growth impact. And the Fed, I think, is quite worried about the labor market. Labor supply is coming down, but I think labor market demand may be coming down at a faster pace. So even if the unemployment rate does not rise substantially, because, again, the participation rate may be moving, if labor demand is moving, then the Fed will pay attention to that. I think we're looking at quite a dovish Fed, despite higher inflation, starting from September.
Yeah, that was my next question. You kind of kicked off on it there when you're talking about the unemployment rate not really budging because participation will shrink. Is that something that's going to complicate how the Fed reacts to this? Because, you know, we've heard over and over again that you really have to see a rise in the unemployment rate to get the Fed to cut.
I mean, it's already complicated because if you just put the unemployment rate and where inflation is likely to go in a monetary policy model, like a Taylor rule model, that'll tell you not only stay here, it'll tell you to hike. Whereas the Fed, we think, is going to cut because the Fed is going to take that model, put it in the dustbin, because they're going to think about what's going to happen moving forward, right? So on inflation, I think there is consensus, and you're seeing Waller and you're seeing Williams moving in that direction, that this is going to be temporary. Let's look past this. Unemployment rate is a harder question. Should you just focus on NFP or should you focus on the unemployment rate? But the unemployment rate, I think the Fed will say, if NFP is going sub 50, the unemployment rate will tick higher, and we're going to not wait for that. We're going to react to that now. Why shouldn't you wait for that? Because you're in extremely restrictive monetary policy, so it does behoove you to at least move to neutral quite quickly if you're uncertain, and that's why I think the Fed's going to be dovish.
Do you think we're going to have any dissents at the meeting in July?
I think the Fed will point in that direction. I don't think it's too early for them to move, I think, at this point, because, again, you would not have seen overall growth come down by that much or the labor market weaken by that much, but we are moving in that direction. We think September is the time to move.
Banu, you said I'm going to put all these threads together if I can. You said you're neutral on Mag 7, but if you are expecting a dovish move from the Federal Reserve off of, you know, geopolitical risk or whatever, despite the inflationary pressure, shouldn't that be a tailwind for mega cap tech that has traditionally rallied when rates come down?
So first, I'm neutral on Mag 7 within the context of a conservative view on equities. So equities come down X, Mag 7 comes down X, right? So we're looking for equities to correct here over the next 3 months. That's the first point. The second point, you're absolutely right. Usually when rates come down, Mag 7 reacts quite positively. But we really have to, at this point, make a difference between, lay out the difference between the front-end rate and the back-end rate, right? You could see the Fed cutting rates by 75 or 100 basis points from the 6 months starting September, but the back-end rate may only move down by 20 basis points. The cost of equity is not the overnight rate. The cost of equity is the long end, and the long end may not come down because of supply concerns. They may not come down by as much. I think the curve is going to bull steepen.
Except for tech specifically, they react to the front-end rates because they're sitting on so much cash, and it's a liquidity story more than it is necessarily a refinancing story the way it would be for the rest of corporate.
I think if you look at the cost of equity, even for the Magnificent Seven, it's between 5 and 30-year, not the overnight rate, right? So I think that rate, if you see the 2-year come down to 3%, but the 10-year come down only to 4.2%, I don't think that's going to be such a big tailwind for them. And by the way, you also have to look at why rates are coming down. And if rates are coming down because NFP is at 0 or 50K and real PCE spend remains extremely weak, that will tell on Apple's earnings or Tesla's earnings. And many of these companies you will see as being quite cyclical as well.
OK, Banu Baweja, thank you very much indeed, as ever, of course, Chief Strategist for UBS Investment Bank, with a word of caution there as we lead up, of course, to earnings season that kicks off in earnest this week with the banks up front and centre towards the back end of the week. Coming up, the EU is said to be stepping up plans to engage with other countries hit by President Trump's tariffs. More details as trade talks between the US and the European Union drag on. That is next. This is Bloomberg.
30 minutes away from the start of the opening trade. Futures are selling off in a very big way. In just the last 30 minutes, we've seen them drop pretty substantially. Euro Stoxx 50 futures down almost 0.8%. It is worse on the continent. You're looking at the DAX, for example, almost 1% declines there just in the futures picture. The FTSE 100 relatively sheltered from that. How much of that has to do with the trade deal story? An extra special emphasis on the CAC 40 as well, down about 0.9% as we got some comments from Emmanuel Macron talking about increasing defense spending. Who knows what it'll do to the deficit?
Now let's take a look at the European bond open this morning. It does seem like there is a bit of a flight to safety going on. German 10-year yield is down a basis point on the session. This is despite a substantial rise in Asia and those JGB yields jumping another 10 basis points in the 30-year sector. It does seem like European bonds at the moment are resilient to that, instead acting in a risk-off manner with yields headed lower this morning.
OK, the EU is preparing to step up its engagement with other countries hit by President Trump's tariffs, including potential coordination with nations like Canada and Japan. European Commission Competition Chief Teresa Ribera spoke to Bloomberg and said any escalation of trade disputes should be avoided, while calling for a level playing field.
Of course, we need to ensure a level playing field. We cannot keep our very open economy in Europe in such a context that there may be many people willing to be part of our single market, but that may not be working with the same rules, the same approach, so to reflect the right prices according to the real cost. So I think it is good to explore with the rest of the world how we can work together, and it is good to try to avoid this escalation with the United States.
OK, for more, let's bring in Bloomberg EMEA News Director Ros Matteson. Ros, the latest lines from the Trump administration, 30% for the EU, 30% for Mexico, and reporting from our own team that Europe is now looking to potentially coordinate, or at least work more closely with countries like Japan and Canada. Where do things stand?
Well, it's interesting to see the latest comments from the EU. It'd be interesting to know what exactly coordination means with countries like Canada and Japan. Does that just mean trying to work out a common approach to dealing with the US administration? They're all trying to work out, again, how to get through without avoiding an escalation. We just heard intentions, but also staking their ground and being very clear about their own red lines and making sure they're not giving too much away. How do you do that? Is it a lot of carrot? Bit less stick, bit more stick, less carrot. So we're trying to figure out how to negotiate here, and maybe it's coordinating their approaches in that regard, or is it coordinating a response? Are they going to say, let's all go in hard and retaliate here? Perhaps like working out their responses collectively, because if one goes, they probably should all go in terms of retaliation. But it's also about, again, just diversification. And we've seen this from the EU and elsewhere since the start of this latest Trump administration, which is saying we can't put all our eggs in the US basket. You can see the EU working out, again, we need some kind of trade and investment relationship with China, even if that is tricky. Outreach to countries in the Middle East, the UAE and others, saying let's build our trade ties, and also, again, with countries in Asia. So a lot of countries saying we can't just rely solely on the US so much, at least so much for our trade and investment and business, and we need to deepen our relationships. Will it replace the US? No, but at least offers a bit of a buffer and a sense that the reliance on the US in terms of being a key marketplace, that has to be reduced around the world.
Roz, is there any sense that there could be, a risk to the Trump administration for constantly moving the goalposts, even sending this letter to the EU amidst trade negotiations, which for everyone thought were going pretty well and were near a conclusion? Is there a risk that could actually backfire?
We see lots of countries being caught by surprise. I mean, Brazil last week, Canada, now the EU, countries around the world to some extent who were like, well, we thought things were going well. We were having conversations. We're knee-deep in negotiations, and suddenly we get told, this is your deal, this is your number, and this is what you have to do with it. And so it's quite difficult in that environment to have deep and complex negotiations. I mean, even a trade framework, let alone a trade deal, is complicated. And Donald Trump and his administration are figuring that out because they've only got a few deals done so far. But if you're shifting the goalposts, keeping people on edge and confused, are we going to get to a point on August 1? Is that the real deadline, or is that just yet another deadline that they will go through? It's really hard to know. Is that the line in the sand, or is it another line in the sand that's coming? So having negotiations in that environment is very difficult. And for the US, again, it's just bit by bit reshaping the way that countries think about the US. in the longer term. And that's really the change that structurally is going to matter, is the longer term. This is trade noise. We'll probably get through it. But if the way that you think about the way that you interact together in the longer term is changing, that perhaps does open the US up to some risk.
All right, Bloomberg's EMEA's news director, Rosalind Matheson, walking us through those dynamics. We thank you so much. In the meantime, let's talk about how that all translates to the view over in China, because I'm old enough to remember when Ursula von der Leyen and several ministers across Europe said they have a very strong alliance with the United States, one that outshines that of their relationship with Beijing and some of their Asian counterparts. It looks like that dynamic has changed as Ursula von der Leyen and others look to the east rather than west. Alan Wong, Bloomberg's China economy and government editor, is all over the story. Alan, can you just dive into that dynamic for us, the relationship between Beijing and Brussels, when just a few months ago we were talking about EV tariffs, EV capacities, investigations, cybersecurity? What happened?
In short, it's complicated. EU, China, they are two very important markets, and just because we had China's latest trade figures for June today, you can tell that the EU is actually a bigger customer than the US when it comes to China's exports. And with that kind of consuming power in the EU, and with China having some sort of an overcapacity problem at home, the EU means a lot to China as an export market. And the fact that the EU is also will engage in some talks with China later this month will just bring the focal point further on this relationship, because if the EU will keep its door open for Chinese goods, then China will find a very valuable market for its products.
Alan, talking of markets, talking the impact on the export engine of China, we have had data out today. What kind of impact are we seeing from US tariffs on that Chinese trade engine when it comes to exports and trade? Yeah,
so in the second quarter of the year, China's exports to the U.S. fell a lot, fell about a quarter. But as I said, the EU is now China's biggest export customer, so that means that the export strength to the EU made up for a lot of that loss. And in fact, the export data show that China's exports beat expectation in June and remain very, very robust, which has some implications about China's economic outlook. And the other market to look at is China's export to ASEAN countries, which is a major hub for transshipment and for rerouting goods through, and maybe to the United States, but also to other markets. So exports to ASEAN countries were also very strong in June, which gives China some breathing space before it has to carry out more stimulus.
Alan, you just mentioned more stimulus there. I mean, we do have more data to come out of China, quarterly GDP, and then all the activity data comes out tomorrow. What could that mean in terms of how trade data is impacting growth? And do you think there'll be more calls for monetary and fiscal stimulus?
I think those calls will never end, but the data tomorrow may just give those calls, may just dim those calls further, because we're expecting to see growth in the first half to exceed 5%, which, remember, is China's growth target for the year. And if the first half gives China such a strong showing, despite all the U.S. tariffs, then Chinese policymakers might just feel that they have more time to carry out their stimulus program, which they promised, but now economists are expecting rate cuts later this year, and the cut to their RRR, which decides how much money banks need to keep with the central bank and how much they can lend out, those kinds of easing will come later during the year.
OK. Bloomberg's China economy and government editor Alan Wong on the data that's come through, the tariff impact and maybe stimulus delayed for China. Now, President Trump says the US will send more Patriot air defense batteries to Ukraine, which Kyiv says are needed to protect against Russia's ongoing airstrikes.
I haven't agreed on the number yet, but they're going to have some because they do need protection. But the European Union is paying for it. We're not paying anything for it. But we will send it. It'll be business for us, and we will send them Patriots, which they desperately need.
Well, this comes as Axios reports Trump will announce a new plan to arm Ukraine, possibly as soon as today. Let's get more with Bloomberg Russia economy government editor Greg Sullivan. Greg, what more do we know at this point?
Well, we do know that President Trump has changed his tone and said that he will provide these Patriot missile batteries. Ukraine has said these are weapons that they desperately need for their defense. The Pentagon had been supplying or air defense missiles and artillery shells, but then they halted those deliveries, saying that they needed to assess their own stockpiles. This is clearly a reversal from that, with President Trump saying he will provide these Patriot missiles, which Ukraine had been seeking. It's also important to note that he said that the U.S. would not be paying for them, so they are not donations. Instead, earlier they had talked about the European allies, NATO allies, helping to fund these deliveries to help provide to Ukraine. Ukraine has also offered to buy their own air defense missiles, so that is something Trump emphasized in his comments announcing this reversal.
Talk to us a little bit about that reversal, though. I mean, what has actually changed? Is it simply just the relationship between Donald Trump and Vladimir Putin, or is there more to it?
There does seem to be quite a change in President Trump's approach to Vladimir Putin. This is probably coming from a number of things. One would be the Russian intransigence in the ongoing peace talks. Russia has these peace talks have produced basically no progress towards any kind of a ceasefire or peace. And Russia seems very unwilling to negotiate any kind of peace at this juncture. We've heard that Russian President Vladimir Putin is willing to continue his war and wants to continue it. So there's been very little progress out of that. We know that Trump, during his election and in the first months of his term, has said that he would bring about a peace very quickly, which Biden was unable to do, his predecessor. That hasn't happened. Instead, we've seen an uptick in drone and missile barrages, which President Trump has expressed frustration over. These have become increasingly deadly. They are setting new records in terms of the numbers of drones and missiles. So that's frustrated President Trump. So there is a shift in tone taking place here. What that leads to still remains to be seen, but potentially this announcement, possibly as soon as later today, will shed more light on that.
All right, Bloomberg's Greg Sullivan walking us through those dynamics when it comes to defense aid out of the United States and what that means for the course of the war in Ukraine. We thank you so much. Coming up, we're going to go right back to the stock market. We're about 18 minutes away from the opening trade across Europe. BASF is one stock we've been keeping an eye on, cutting its outlook, warning that tariffs are weighing on demand. We're going to break down the impact on today's stocks to watch. Stick with us. This is Bloomberg. We're already getting reactions from various members at the European Commission in terms of the 30% imposed, or threatened, I should say, from Donald Trump imposed should August 1st come about with no deal. The shot you're looking at right now is at the European Commission. We are getting comments at the moment from the foreign minister of Denmark, speaking, of course, ahead of the EU trade minister meeting. He's making some key comments, a complete kind of pushback from what the likes of Emmanuel Macron are suggesting the EU do in response. He's actually saying that you shouldn't impose countermeasures against the United States right now, aiming to, of course, put an emphasis on the Mercosur deal at the end of the year, saying that he wants to have a fair deal with the United States and not a trade war. Coming at it with quite a bit of optimism when it comes to that. At the same time, we have comments from the EU Trade Commissioner as well, Sefcovic, talking about preparing well-balanced countermeasures against the United States, saying that those conversations are likely to have with their counterparts later today. Tom, Val, I think this is fascinating because right off the bat, you have two key members. You have the Danish foreign minister. We should remind everyone that Novo Nordisk and Ozempic and pharmaceuticals out of Denmark are a key export from Europe into the United States, talking about staying calm, keeping calm, carrying on, waiting until these negotiations happen. Sefcovic bracing for impact, talking about these countermeasures.
Yeah, well, at least they are due to speak to their U.S. counterparts later today. So this letter that was sent from the Trump administration on the 30% tariff, I guess, hasn't, in terms of, derailed any talks that are ongoing. I think the market is still hopeful that we do get some sort of deal announced before this August 1st deadline.
So Sefcovic has been on the ground. He's been the one leading the negotiations with the U.S., so he knows them very well. And there's this core tension that we touched on at the top of the show between what is being pushed by the French president, which is a more aggressive and a tougher stance versus the US, versus what we're hearing from the Germans and Friedrich Merz talking about the core interests of Germany now being put at risk. Can they hold the line, the Europeans, as they close in to August the 1st in terms of working as a collective and being unified, particularly when those sectorial tariffs continue to be threatened? They want those carve-outs. They don't want that being an impending risk that can come down the line at the end of the investigations that are taking place in Washington, and that has been a key sticking point.
Who is the voice of Europe. It keeps coming right back to that. Let's talk about how the markets are interpreting all of this. Markets Live executive editor Mark Cudmore jet-setted into London just for this conversation. Mark, how do the markets interpret this? How should they be interpreting this?
So first of all, they're not particularly bothered, given how much we reacted to kind of these threats a few months ago. Sure, we've seen the euro a bit weaker, European stocks are a little bit weaker, but there's no dramatic reaction. Essentially, people have become kind of a little bit immune to these tariff headlines. We've had so many, and I think that's the right reaction. Essentially, we're going to care about implementation. And it's not that people are oblivious to this is a serious risk, but we have no real clue whether the risk is going to come through. We've now learned that the negotiation style, if we didn't know that in advance, is going to be very, very aggressive and hardline to the end. That doesn't mean a deal won't happen. It doesn't mean that nothing will ultimately be implemented. So I think people are saying we have to wait and see. And there's actually two layers of wait and see now. It's not just wait and see what the tariff will be, but it's wait and see what that will be feed through into the impact as well in terms of hard data. So I think the tariff story is something that's going to continue to be really, really dominant for many, many months, but it's not easy. I think the short term, this is going to be a bit of a negative for stocks. I think the move in the dollar higher will probably fade by later on in the week, because I think it's going to go back to a sell America trade, because what it's really emphasizing in the long term is the idea is that the rest of the nations have to slowly start moving, slowly is a key word there, their supply chains away from America and start aggregating to have other businesses that don't incorporate America.
Mark, do you think that this Sell America trade could come back if we see increased pressure from the Trump administration on Powell? We've seen that fact that he's opened up almost a new front against Powell, really eyeing these the renovation project to the Federal Reserve building. Are you thinking that's something that could return this Sell America trade?
Definitely, that's I think an underpriced risk out there if Powell gets removed. I think it's really important when you mention Sell America trade is Sell America trade is very different from American underperformance. So I think American stocks will underperform for many years, but that's actually in a bullish view of the rest of the world. Sell America trade tends to be focused more around the dollar, and it's about selling down their overexposure. It's not about abandoning the US. So I think they're two different trades. Sell America trade can only ever be tactical, can only ever be held short term. You've got the world's most profitable companies, you've got the largest economy in the world. You know, US has many inherent advantages, just the world's overexposed to it. So I think, yes, tactically we are due for another round of perhaps Sell America, prompted by these tariff headlines, prompted by the threat in Powell, but that is only a tactical trade. Longer term, US stocks underperformance is sustainable.
And longer term, you see further weakness for the US dollar, as you've discussed. We're seeing the upside for the greenback in the session today. If we do get the scenario, and you've talked about the fact it's so hard to know what is actually going to be implemented at the end of the day when it comes to tariffs. If we do get a scenario where we're getting 20, 30% tariffs on European goods and maybe countermeasures, what is the impact on... Does that continue to play into your story of dollar weakness? How does the euro function in that, particularly versus other crosses with some of its key trading partners? What are the prospects for the euro in that kind of scenario?
Well, I think actually that the bigger driver of FX will be the kind of slowly just reducing US dollar exposure at the margin. Again, the US will stay the world's reserve currency, the US dollar. It's not about abandoning it. It's just about reducing from the overexposure there. I think that's the bigger driver. So the euro will do well against the dollar. On crosses, I'm not particularly bullish the euro, but it does have the idiosyncratic fiscal spending story. And also, when you diversify away from the US, the first port of call is going to be the next most liquid market. So euro will benefit over the next year or two, and then people will start diversifying much further afield, like to Asian emerging markets, but that's the kind of 4 or 5 year trade.
Well, you mentioned the emerging markets. Not only did we get 30% on the European Union, we got 30% on Mexico as well. Do we brace for impact?
Well, I mean, Scheinbaum was very positive in saying, like, we expect a deal. They kind of dismissed the risk here. So I think that essentially... It's the exact same with the EU story. I think it's very unlikely that we're going to get a super aggressive to high tariff rates against all these major trade partners at once, Canada, Mexico and EU. I suspect it's very likely they'll get at least one. I think Trump is basically lining up to kind of who doesn't get in line, and I'll pick on one of you, because he does want the revenues from tariffs and he does want to maintain a hard line. So I think there's going to continue to be damaging for the US, but traders don't know which country will ultimately be the main victim.
OK, Bloomberg's Mark Cudmore, head of MLive, of course. Thank you very much indeed. In terms of thoughts around how FX are responding to this and how the equity markets can maybe afford to look through the tariff volatility, let's check in on some of the stocks to watch as well this Monday with Chloe Melly standing by. Chloe.
Good morning. Let's start with some weak hiring data from the UK this morning, which might feed through into some weakness for recruitment companies in the UK. So we have got a report saying that the UK hiring fell at the fastest pace in 2 years, which is particularly bad for recruitment companies, which have already been having kind of a tough year. So we can see Page Group, Hayes, Robert Walters have seen quite a lot of weakness. Some of them have cut guidance over the last few months, and more weakness is is to come with this latest report. One of the authors of the report said that this was really about that hesitation that stems from the tax rises that we've seen implemented in April, and how that is really impacting the confidence from UK businesses in terms of their ability to hire people. And then moving on to defence, Macron said in a speech on Sunday that he would double the annual defence budget for France by 2027 rather than 2029 as originally planned. And we might see that kind of boosting some shares in this morning in the French defence space. So Thales, Safran and Dassault Aviation in particular. Safran a little bit less. It is also a bit more exposed to civil aerospace, not just defence. So it's been has seen a little bit less strength than we can see with Thales and Dassault. But we are probably going to see a little bit more of a boost this morning on the back of that news. And then finally, we have got a guidance cut that happened on Friday after the close from BASF, the chemicals giant over from Germany. It said that this was really in response to tariffs and the uncertainties that was created by the trade war. The shares have been kind of seesawing up and down a little bit over the last few months and never really recovered, as you can see from the highs that we saw in 2020, 2021. And this is really unlikely to provide any boost this morning.
All right, Chloe Melly, our equities reporter, walking us through some of the stocks that could be open, or could I should say move at the opening trade. It's fascinating. She's talking about some of that tariff impact there as well. I'm curious to keep an eye on, of course, Diageo's one in terms of the Mexico read-through and the tequila read-through there as well. And that's not just because I like tequila, but because of this actual read-through. We've seen every tariff headline has affected that stock. But Spanish banks are another one as well that have that LATAM exposure that could actively trade on it. Autos, defense. Chloe mentioned a couple of those there.
Okay, so on a sector-by-sector basis, maybe some of the individual names will reflect more anxiety than maybe the headline moves that we're seeing in the markets, even as you see futures flag lower right now by close to a full 1% on the S&P, on the Stock 600, of course, currently pointing low by 0.9%. Coming up, it is, of course, the opening trade. We'll get the prints, of course, in about 5 minutes' time. Futures pointing lower. This is Bloomberg.
A few minutes to go until the opening trade. Markets have a lot to digest. Now, as we're kind of ready and bracing ourselves for that market open, we are, of course, keeping one eye on what's going on in Brussels. The ministers there, the commissioners there, they have an early start, and they are really bracing themselves for how to deal with the United States. In the meantime, the market picture looks like this. We did see last week end with a sell-off in Europe. Down, 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 and then a rally into the States. And I think this is really crucial because what kind of pullback does it set us up for, Val?
Hey, we're still seeing an underperformance when it comes to European futures versus U.S. futures taking place today. Euro Stoxx 50 futures down 0.8%. Some upside in FTSE 100, only down 0.1%. And when it comes to DAX, down near a full percentage point when the futures picture looking pretty sour this morning. Tom, what stocks do we have our eye on so far?
We're focused on defence out of France with the announcement from French President Emmanuel Macron over the weekend that he would be looking to ramp up defence spending. The numbers are this. So from 2017, when he first took office, he's looking to double the spend, around $75 billion US. That's by 2027 instead of 2029. So it would require an additional 3.5 billion euros of spending next year. So look for the defence stocks over in France and beyond on the back of that announcement, joining Germany. Not the same size and scale, but nonetheless, both France and Germany looking to ramp up defence spending. Autos in focus, of course, with that threat of 30% tariffs, could be amongst the most exposed if indeed they are implemented come August the 1st. And BASF, that chemicals producer, of course, out of Germany, cutting its full year guidance. Tariffs and impact, energy costs have been a challenge for BASF as well. So 3 stocks, or at least 3 baskets to focus in on come the open. Kriti.
Does it show up on a sectoral basis? Does it show up on a regional basis? Are more countries exposed to the kind of 30% than others? That's going to be the conversation. I think what was so stagnating is that difference between the FTSE 100 and the Stock 600 in terms of futures pricing. Right out of the gate, the FTSE 100 is flat at the moment. And I think this really speaks to the sensitivity that we're seeing, at least on the continent, when it comes to that 30% threat from Donald Trump when it comes to those tariffs. Should an agreement not be reached right out of the gates, down about 0.4% on the Stock 600. But look look at where the pain is. It's the IBEX down 0.8%, because remember, he didn't just say 30% on the EU. He said 30% on Mexico as well. Lots of Spanish companies have a footprint in Latin America and specifically in Mexico, and even the CAC 40 down about 0.7%. We're going to wait just a little bit to see how the DAX opens up. But in the meantime, Val, walk us through some of those early movers.
Well, when it comes to the sectors, we have them all in the red this morning. All 20 sectors seeing declines. We have 442 stocks in the red, only 55 higher this morning. It does seem like some of those trading higher this morning are some defense names. Dassault Aviation up 1.5%, one of the biggest gainers, but many stocks to the downside this morning as we continue to open up. When it comes to the sectors, we are seeing technology at the bottom of the basket, also autos at the bottom of the basket. I wonder if that's around the new number for the EU from the U.S. when it comes to those tariffs. We're seeing many of the auto names in the red so far this morning, but all sectors seeing declines.
The FTSE MIB is plummeting 1% right now. The DAX has yet to show us a print. The IBEX down 0.8%. To some of the individual names, having touched on the sectors then. Bottom of the list, you do have the likes of BE Semiconductor. So Val was talking about the tech space and tech sector being under pressure. That stock, BE Semiconductor, currently down 2.6%, amongst the worst hit right now. In terms of some of the gainers, you have some in the financial space amongst the insurers, but also AstraZeneca in terms of pharma, 1.3%. Prudential, talking of insurers, up 1.2%. Standard Chartered, a gain of a little over 1%. Dassault Aviation maybe getting a bit of a lift on the back of the French spending pledge around defence. That company is up also 1%. Raiffeisen Bank, interestingly, in Austria, down close to 2%. So we're seeing, of course, the pressure coming through at the headline basis is the tariff impact and how markets are adjusting to that on an individual company basis as we start earnings season as well. Let's get a broader picture now, because we're hearing, I believe we're still hearing from the EU Trade Commissioner, Maros Sefcovic, who's speaking. We're taking live pictures right now. That's in Brussels. He said he will be reaching out to his US counterparts, of course, on the back of this letter that's been sent to the EU with this 30% tariff. Let's take a listen in. Those tariffs expected to take place August the 1st. Let's listen in.
From the United States, it has more or less the same effect. So it's practically it prohibits the trade. So if you're talking about 30% or 30% plus, there will be a huge impact on trade. It will be almost impossible to continue the trading as we are used in a transatlantic relationship. And if you look at the impact this would have, so I have to say the transatlantic supply chains would be heavily affected on both sides of Atlantic. They definitely don't want it. Show me one industrial leader who is happy about this tariff policy. So therefore, we feel the huge responsibility for the biggest trading relationship on this planet. $1.7 trillion, $400 billion flying across the ocean every single day in the form of goods and services. So therefore, we are showing this enormous patience, enormous creativity to find the solutions. But if it stays 30 plus, simply the trading as we know it, will not continue with a huge negative effect on both sides of the Atlantic. And therefore, I think we have to do, and I will definitely do everything I can to prevent this super negative scenario. Thank you very much. I have to see you at the press conference. Bye-bye.
All right, Maros Sefcovic there, the EU Trade Commissioner, talking about perhaps the response. He has a fairly measured approach, but as we know earlier, he did say he's ready to brace for potentially imposing those countermeasures. We know the anti-coercion tool is something that Emmanuel Macron has been pushing the European Union to utilize. In the meantime, let's talk about how these markets are reacting. Sharon Bell, senior European equity strategist over at Goldman Sachs, joins the table this morning. Sharon, walk us through this market reaction. I mean, clearly right out of the gates, we are seeing a fairly large one for the Stock 600 relative to the FTSE. But for the first time, we're actually seeing a reaction, whereas for weeks and arguably months, we haven't.
Well, I think the markets had got a little bit optimistic in the last few weeks. And particularly last week, there was expectations that perhaps some framework would come out, which was a bit more positive between the EU and the US. That hasn't arisen yet. And instead, we've got this 30% tariff threat. So I think it is a little bit of a knock. I mean, if the market really genuinely believed in the 30%, it would be down a lot more. So I do still think there's an element of, do we believe this will be the case? Is this a negotiating tactic? Is this a first move, etc.? But yes, I'm not surprised at the negative reaction.
When it comes to the negative reaction, though, I mean, it feels like it's also, to your point, just a little bit of a retracement as well. Coming to August 1st, how do you brace for August 1st?
Yeah. Look, if we're at August 1st and nothing has happened and the 30% arrive, then I think the market will be down between now and then. I mean, I see this as just part of a negotiation back and forth. It is tricky. One thing I would say is that in the last few months, not only has the market positively moved since Liberation Day, and we've recovered most of those losses, if not all of them, but cyclicals have also done extremely well. So I think there's a little bit of an element of the market being perhaps a little bit too complacent in the very near term on the risks around all of this. I mean, if there is a great deal, then, and you've got this defence spend, we've just heard from Macron on even more sooner, you've got fiscal policy, all that's fantastic. But, of course, if there isn't a good deal, then that's the danger.
But you mentioned the cyclical outperformance. How much of that is it fair to say that was more of a rotation rather than a fundamental shift in optimism around the European growth story?
Oh, I mean, cyclical outperformance has been true in the US and Europe in the last couple of months. And I think it's to do with the fact that at Liberation Day, people were very negative, looked at the economic implications, and cyclicals had underperformed very sharply. So it was a bit of a bounce back in that type of performance. But it is also a genuine reflection in Europe of a bit more fiscal spend, a bit more defence spend, a bit of expectation of a cyclical pickup in 2026, which I think is there, provided you don't get the harsher tariff scenarios.
Sharon, you mentioned there that the market doesn't believe it. You know, that's what I see even in the FX markets this morning. They don't seem to be believing this 30% number. But in that framework, is this just a dip to buy? Are you adding to some of your long positions here that might be in the red?
Yeah, I understand what you're saying, but you know, I think that the market has done well. The European market trades on a PE of about 14 and a half, so which is sort of 70th percentile of its historical range. It's not as expensive as the US, and we still think there's relative value in the market, and we still like the idea of diversification. But markets have all bounced. And there are still risks around the impacts of some of these tariffs. And even if you don't get the 30%, even if it's a negotiation tool, it may still mean that the sort of people's expectations for the baseline is also going up.
And we're about to head into earnings season. At least the U.S. kicks off in full force with banking earnings. Is there any sectors you specifically have your eye on for any clues about how these corporates are dealing with this tariff back and forth?
Yeah. So, I mean, I guess it will be the more international sectors. I mean, European earnings season is also really kicking off this week. We have about 10% of companies reporting this week, so it's quite a big week in Europe too. I think it's got to be the more international companies, hasn't it? The ones which are exposed to global trade. So industrials, chemicals, but also even things like consumer staples, etc., which in Europe tend to have very global footprints as well.
Sharon, how much of a catalyst can dividends and share buybacks be for European stocks through the second half of this year?
I mean, they've been a huge catalyst for banks, for example. I mean, if you take the bank sector across Europe, so the stocks Europe bank sector has about 9% return to shareholders each year from dividends and buybacks. Dividends about 6%, 3% on top of that in buybacks. So it's a really big deal for certain sectors. It's one of the reasons I think banks have done very well. I mean, will it compensate if there is a big tariff and a big hit to growth? Absolutely not. But I do think it's a big help. European companies are making good amounts of cash, and they're giving a slice, not all of that, back to shareholders. I would say that you've also seen it pick up in other uses of cash too. M&A, for example, has definitely picked up this year. So again, all those uses of cash I think are helpful.
Is M&A what draws you maybe to European small caps, the prospect of M&A around the small cap space? Because that outperformance has been there for European small caps. Does that have sustainability? Does that have further to run?
We do think so, yes, perhaps a little bit further to run. European small caps have done well, very much in contrast to US small caps, which haven't done well. And I think, so it's been the large caps, the mega caps, that have done so well in the US. Small caps which have done well in Europe because they're a bit more domestic. They're a little bit less exposed, directly anyway, to the trade tariffs. They also benefit from the euro rising versus the dollar because they're not dollar earners in general. They also have floating rate debt, and interest rates at the short end have generally been coming down. So all of that mix, not bad for small caps. And as you say, M&A plays into that as well. You've seen it pick up in M&A, and they're the targets.
Can you just talk to us about this kind of rate differential here? We had UBS's Banco come on the show earlier, and he said, look, there is a inflationary impulse naturally coming from this tariff effect as well, but he still thinks there's going to be a dovish Federal Reserve. How dangerous is it to kind of double down on a dovish take or a dovish sentiment when inflation is still potentially an issue in the short term?
Yeah, Yeah, I mean, we do. We also put in extra rate cuts from the Fed relatively recently. We now expect 3 this year and 2 more next year with a lower terminal rate forecast. And some of that is because the tariff effects have fed a slightly less through to inflation than we expected. And a little bit, to be fair, less through to growth than we expected. But growth is likely to dip. It is a bit weaker in the US than what I would consider trend growth. And because of that, and because rates are a little bit above what would be the neutral rate from the Fed's perspective, we think that they will cut. But, you're absolutely right. There is risk if lots more tariffs will be inflationary. And on top of that, of course, the dollar falling is inflationary for the US.
Sharon, are you worried about the level of euro-dollar here at all, affecting European growth or maybe inciting worries about deflation, or are we not there yet?
I don't think we're there yet. And actually, but European inflation is a very different place, I would say, than US inflation, because you don't have tariffs pushing it up in the same way. And you've had the euro stronger, and that will push down on inflation. So I think inflation is well under control in Europe, I would say. I don't worry about the risk of deflation. What I do worry about, though, is that the earnings of European companies with a lot of dollar exposure, and there are many, many of them, with about 50% of European company earnings are outside of Europe, easily, maybe even closer to 60%. And a lot of those are dollar denominated. Just merely translating them back into euros takes a hit to earnings. Earnings growth this quarter, year on year, we think was basically flat in Europe. And that's largely because of the stronger euro.
Flat earnings growth as a result of strong euro. I want to look back to the top of conversation. I think we've kind of almost got there, which is around the tariff impact. You said you would see, so I want to get to a point where 30% is implemented on August the 1st. You say you would see a drop in European equities. Not controversial, that view.
No.
Give us the kind of size and scale of what the kind of move would be.
Yeah,
in that
so
scenario.
Our economists are saying that if you got the 30% tariff and that was implemented, we'd see about a 1.2% hit to GDP. Which would happen relatively soon, within the next year or so. That's quite big. Bear in mind that Europe, trend growth is probably 1 or maybe slightly sub 1 in Europe. So that's taking away a year of GDP. It really is quite a huge hit to GDP growth. An earnings hit as well. You would then see a negative outcome for earnings, probably single-digit negative, but still negative earnings growth this year, probably into next year. And with valuations already up at 14 times PE, that would be very difficult to justify with that type of tariff. And, of course, on top of all of this, if there was a 30% tariff, there's a much higher chance of Europe retaliating. So then you get a more of a trade war. But, all of these, I think, they're scenarios rather than what will be our base case.
Fascinating to find out how these markets react, or if they do or continue to sell off. I think we're about 2 weeks out from that August 1st deadline. Sharon Bell, senior European equity strategist over at Goldman Sachs, telling us and walking us through some of those scenarios. Let's get a quick check on those core 6, the heavyweights, of course, that move the market in a very big way. This is a surprising one. I thought Novo Nordisk would get hit harder on the idea that it is one of the key places that would be affected by pharmaceutical tariffs and, of course, the 30% from the EU in terms of exports to the United States. The market is doing the opposite, down about 0.7%. One of your sole outperformers this morning, and I wonder how much of that is retracing some of the pain that has been priced into the stock. LVMH also taking a hit, down about 1.3% as well. Ferrari down about 1.5%, and ASML, I think, is also a key one because it's actually one of your biggest weights on this market, even though it's only down about 0.4%. The tech trade is not doing well, but keep an eye on Novo Nordisk, higher by 0.7% this morning. That is your core 6. Let's get a check on some of the other individual stocks on the move. Chloe Melly has that for us. Chloe.
Good morning. Let's start with some French defence names this morning. So Macron announced that he would double the annual defence spend in France by 2027 rather than 2029 as originally planned. This morning, that is moving some key defence names in France higher. Thales and Dassault Aviation in particular. Safran not so much, but Safran is not as exposed to defence. It also has quite a big exposure to civil aerospace, so it's not seeing as much of a benefit. But Dassault in particular up 1.4% this morning. Moving on to chemicals. chemicals. We had a couple of names this morning that are affected by a guidance cut. So BASF was down a little bit more at the open. It cut its guidance on the back of tariffs and the uncertainties created, and that was the same for a smaller company, Brenntag, and it is seeing quite a bit of weakness this morning, 2.6% on the back of those guidance cuts due to tariffs. Then also speaking about tariffs, we have got car makers, and we have a wall of red this morning from those German car makers, Volkswagen, Mercedes and BMW. There is obviously the tariff rate of 30% on the EU and Mexico, and that's having some impact on those car makers that have those manufacturing facilities in those regions. So the one worst hit so far is Volkswagen at about 1.3% down this morning. Let's move on to a pharmaceutical company, AstraZeneca. It said that it had a blockbuster potentially on its hands with a drug that helps with high blood pressure. That's moving the stock up as much as almost 2% this morning. And then finally, we have got a rating cut at Hermes. So Hermes has been cut from buy to hold by Jefferies. Jefferies said that the company would maybe not see as much of a significant growth uplift going forward. Hermes has been outperforming its luxury peers so far, so that is sending the stock down a little bit, as much as 2.2% this morning.
OK, Chloe Melly from our equity team on some of the stocks on the move this Monday. Thank you. Coming up, the EU and Mexico lay firmly, of course, in the tariff crosshairs. We discussed the outlook as the auto sector awaits clarity. We're seeing pressure, as Chloe was saying, on some of the automakers on the back of this news. That conversation coming up next. More details, more analysis. Stay with us. This is Bloomberg. Welcome back to the opening trade. There is caution in these markets, but certainly no sense of panic, with European stock 600 down just 0.4% on the back of the tariff news. Of course, 30% threatened by President Trump on the EU and Mexico, with August the 1st, the new deadline.
Absolutely. We're going to keep a very close eye on the read-through there and dive into that trade story. But in the meantime, something else brewing on continental Europe, and that, of course, is the banking consolidation story. UniCredit says it will assess the next steps on its takeover plan for Banco BPM. This comes amid doubts over whether the deal will go ahead following a ruling by an Italian court. Let's bring in Bloomberg's Italian bureau chief, Chiara Albanese. Chiara, can you just walk us through this court ruling? Can you walk us through the challenges that Andrea Orcel faces?
Yes, good morning. So the Italian government has applied really tough prescriptions on UniCredit to continue a plan to take over Banco BPM, which is a smaller lender based in Milan. Now, the bank led by Andrea Orcel, UniCredit, appealed to those decisions to an Italian court, and the court actually took a midline on the government position, deciding that some conditions are too tough, but others remain in place. So UniCredit will now have to decide whether it can still seek to buy Banco BPM with complying with those conditions, or instead will just drop the offer.
Chiara, what are the key steps ahead that the market is watching out for?
So there are several pieces of the puzzle that will influence UniCredit's decision on top of the court ruling that we just mentioned. The first one is that the European Union is also expected to speak and send a letter on the same prescriptions, and also that the timeline of the offer period is quite tight, and it has to be done and started by July 23rd. So UniCredit only has about a week to clear its mind, announce to the market what it's going to do, and also understand whether these prescriptions will have to hold or not.
OK, Bloomberg's Italy bureau chief, Chiara Albanese, thank you very much indeed with the update there on UniCredit and the Banco BPM potential deal, with some question marks that still remain, of course. Now, key sectors, meanwhile, away from banking, including autos and chemicals and defence, are continuing to monitor the potential fallout after US President Donald Trump dialed up trade tensions by announcing a 30% tariff on goods from the EU and Mexico. For more, let's bring in Bloomberg trade czar Brendan Murray. Brendan, we're seeing autos the worst performing sector so so far in the session, down 1.1%. On a sector-by-sector basis, how significant are the details that we're getting in terms of a headline tariff of 30%? To what extent is this still a sticking point in terms of negotiations, the sectoral tariffs that the EU wants to avoid?
Yeah, well, this is everything for the European Union. There are steel and aluminum tariffs. There are the ones on cars. You're also looking at the threat of pharmaceutical tariffs that the president raised last week at something like 200%. So the European Union is looking at all these going, these will crush our industries. We can't stand for this, so we're going to have to come up with some solution. Now, they can negotiate a solution, or they can fight back. They can retaliate, and they're weighing both of those options. They're saying we want to talk, we want to keep at the negotiating table, but there will be a time that comes when these tariffs, if Donald Trump can be believed, will take effect, and then the European Union are going to have a tough decision to make about how hard they strike back, what industries they strike back at when it comes to U.S. exports. The Mexico and the EU, this is 1/3 of all U.S. imports. So this is a huge escalation if they go through, and there's a lot at stake economically. I think markets are still thinking maybe it's a bluff at this stage, but if it's not, it's a huge economic headwind.
So there's been some immediate reaction here that, okay, if 10% flat rate wasn't that, it's a scary number, but it's not that scary. It's not as cost prohibitive. Okay, 30% may not be as cost prohibitive. But if you stack them on top of each other, the country tariffs plus the sectoral tariffs on, say, a Mercedes that is potentially getting shipped to the United States, have we gotten into cost prohibitive territory?
Yeah, absolutely. I mean, there's no way that you could raise the price of a Mercedes in the U.S. By 50%, and their market share would take a severe hit. So yeah, this is the big sticking point with Donald Trump is he wants Mercedes and Volkswagen and all these European car makers to come make those in Alabama or other places where perhaps they already have a facility, but they're already making vehicles there, and it's going to be those are economic decisions on that the companies have to make that take a while to do. So we could be headed right down to the final day before August 1st, before we could see anything that resembles a compromise. At the moment, there doesn't seem to be that much common ground in between the two sides.
Brendan, do we know or not whether the Trump administration imagines these reciprocal tariffs stacking on top of these sectoral tariffs, especially the one on cars? Have they mentioned that specifically?
Yeah, that's the way it would work. A reciprocal is just 10% or 30% or whatever the rate is across everything, and then you get an extra 25 for cars or an extra 50 for steel. It compounds on itself, and that's why it would be so economically damaging to those countries that export those goods to the U.S.
Bloomberg's Brendan Murray walking us through that as the story develops. We are just over 2 weeks away from the August 1st deadline. We thank you so much. Coming up on the program, we're talking about maybe how the United States and the EU should approach these tariff negotiations, tariff diplomacy, if you will. The EU looking to step up engagement with other nations hit by Trump's levies. Meanwhile, actually within the company or within the country, within the bloc, I should say itself, talking about potentially using the anti-coercion tool. We know that's something that Emmanuel Macron has been talking about for some time. We'll see if that actually comes up. Is that even a viable tool?
He is trying to put that on the table, the French president. Ursula von der Leyen, we can see pictures of her on the screen right now, has said we are not there yet. That would be a measure that would talk to a particularly acute moment in terms of trade negotiations. So it seems broadly across the bloc they're opposed to that, but it's not insignificant that the French president is pushing for that tool and a tougher line in terms of these negotiations.
A lot of interest, a lot of people talking about their own interest in these negotiations. A lot of confusion, I guess, on who to listen to.
Absolutely. We're going to digest all of it. Anthony Gardner joins us next. Stick with us. This is Bloomberg. Welcome back to the opening trade. About 30 minutes into today's session, you're seeing the markets off of their lows. In just 30 minutes, we opened the market with almost 1% declines on the DAX and starting to pair some of those losses, but we are still firmly in the red. The FTSE 100, though, firmly in the green, I think, higher by 0.2%. I think that dispersion between the indexes, Tom, tells you this idea that The EU trade story is really what's driving markets this morning.
Pano Boeja of UBS telling us that there is complacency in these markets. He thinks there will be an impact, that tariffs are something to be concerned about. But to your point, so far that concern is not fully reflected in the market moves. The European Commission, meanwhile, saying that any escalation of trade disputes should be avoided while calling for a level playing field. Competition Chief Teresa Ribera spoke to us earlier.
Trade provides prosperity, and I think it is a good thing. And in general terms, the global value chains are so obviously important for anyone that we should avoid any type of trade escalation, trade war among the different countries between the different geographies. But of course, we need to ensure a level playing field. We cannot keep our very open economy in Europe in such a context that there may be many people willing to be part of our single market, but that may not be working with the same rules, the same approach, so to reflect the right prices according to the real cost. So I think it is good to explore with the rest of the world how we can work together, and it is good to try to avoid this escalation with the United States. China is a great country. Of course, we need to be sure that investments flows are fair and that we do not harm each other.
When it comes to fair trade, what sort of message have you given to Beijing when it comes to overcapacity, not only on clean technology sectors, but also, of course, on rare earth exports?
There are two things that you are mentioning in your question. One of them is, yes, we need to ensure that the overcapacity, the production beyond what it may mean, the domestic demand could overflow over markets. That could be pretty harmful for those that also produce in other geographies. So we need to be responsible, and these formal and informal conversations between the different governments is going to be key. Then there is another issue that you are raising in your question. What about the availability of rare earths, raw materials that may be critical for the new economy, both in terms of the renewable energy solutions or in terms of the digital transformation of our economies? And it should not be a bottleneck killing the possibility of prosperity all over the world. So that is another bullet where we will still need to talk, to discuss, to avoid harm.
When it comes to competition itself, given Washington's tariff threat of 30% by August 1st, is that going to hurt Europe's ability to compete in global markets in the United States? What are your expectations of what that could do to trade flows?
I think it is very bad news. I cannot understand how any country can think that getting isolated from the rest of the world is a good thing for its economy. To what extent fixing the way they want to produce, sell and cut the ties with other providers, suppliers all over the world is not good news for anyone. So I think that it is not good for Europe, it is not good for the United States, it's not good for anyone in the world, because the size of the American economy is so important that it would have an impact, of course. But it is also true that it represents more or less 17% of world trade. So we need to pay attention, to prepare, to be sure, to the extent possible, that this does not become a reality. But if it finally pitifully becomes a reality, we need to keep on working to build resilience and to build partnerships with the other partners, the other allies in the world.
European Commission Competition Chief Teresa Ribera speaking to Bloomberg earlier. Joining us now for more is an expert on trade with deep expertise in diplomacy, but also in business and investing as well. Tony Gardner, US Ambassador to the EU from 2014 to 2017, serving, of course, under President Barack Obama. Currently senior advisor at the Brunswick Group and with a background in business and finance investing as well. Tony, what do you think is the likelihood right now? The market's right to be kind of looking through this 30% threat from President Trump. The known unknowns are there. How should we be thinking about the reality of what is finally going to be implemented in terms of Trump tariffs on the EU?
Well, I think that there's too much complacency in the market. The problem is that the EU is projecting weakness and fragmentation. And let's remember that the EU is, after China, a very, very significant partner to the United States in trade. It has real leverage but it's sending signals of division and weakness, with every member state practically pleading for protection of its export industries. And Trump, of course, is seeing these signals. So he's pushing for more and more. It's feeding his appetite. And this causes a very negative dynamic here, because some of the requests or demands from the United States are very, very broad. It covers not just tariffs, as your listeners will be aware, it covers taxes and digital economy issues and even food standards. And this is very broad. And probably also it includes some of the demands made of other partners like the UK and Vietnam to strip out China from its supply chains. Now, those things are very difficult, if not impossible, for the EU to accept. The real question is, will the EU use the tools it has at its disposal? And I think you were saying beforehand in the program, the EU does have serious tools, recent tools in its arsenal, including anti-coercion, including restricting access to its very significant public procurement market. The question is, will it use those tools?
Tony, to be clear, you think the EU should now be dusting off that anti-coercion tool. It should be lining up tougher measures and communicating that to its US counterparts. This is an EU that needs to be taking a much tougher line right now.
Well, it should, I'm sure it has been, but should be looking at what China did. It met Trump tariff for tariff all the way up 115%. And then led Trump to back down entirely and cut 150% both sides, and they ended up in the same place. That was a big success for China. The EU should be looking at that and saying, well, could we be doing the same thing? Of course, it's much more difficult for the EU to do that because China is an autocracy, the EU is a democracy, and its decision-making processes, of course, are rather slow and cumbersome. So it's difficult for the EU to follow China that way, but China succeeded. There is no cost-free way out of this. Some export industries would take a very significant hit, and that's not negligible. But the EU should convince the White House it does have tools and it's willing to use them.
Tony, talk to us a little bit about the impact, though. China was able to meet that Trump tariff eye for eye simply because they felt like they were able to digest the impact of it. They had that fiscal cushion. They had still a thriving export market that didn't just depend on the United States. Can you say the same about the European Union?
So you're right. So there will be a significant impact, and particularly on certain export industries. And I think cars were mentioned before, which is obviously a big deal for Germany. And the Italians are very concerned about their food exports and luxury goods exports and so on. So I don't want to minimize that at all. But the EU has been very successful in diversifying its trade relationships around the world. Of course, the United States is important, but it's been signing a lot of agreements around the world. It will take time for those to feed, to show results. But as I said, there's no cost-free way out of this. And let's not minimize the impact as well on the United States from some of the things the EU could do. Public procurement is one thing I hadn't mentioned yet. A potential tax on tech companies' revenues from selling ads, or moving against IP rights and doing many things of that kind. The U.S. has a surplus in the services trade, which Trump never mentioned. He just talks about goods trade, where the U.S., of course, has a deficit. So there are serious tools, but I don't want to minimize the impact. My point simply is that there is no cost-free way out of this, and by projecting weakness, it just feeds into a worse outcome.
So, Anthony, talk to us about some of those fines there, specifically in the tech space, because when we've seen this come up before when it comes to, say, the digital taxes, the digital fines put on Apple, I'm going to use that as a case study here. Apple kind of reverberated by just saying, OK, I guess then we won't put AI or Siri services or the latest technology for products that are then shipped to the European Union. Is that a viable way around this for American companies to operate in Europe, that they just limit their exposure to Europe?
Well, some have said that. I know that's what Apple did, but there's also been a lot more bark than bite. I mean, a while ago, you remember when the EU rolled out its GDPR privacy rules, a number of the tech companies said, we're out. We can't deal with this. This is way too expansive a regulation. And then, as you probably remember, a few years later, they said this is the gold standard, which we're going to be rolling out worldwide. And that's not the only example. So the EU has the Digital Services Act, the Digital Market Act. There have been a lot of complaints about that. And I would be surprised that in many cases, that regulation will be used as a gold standard for many countries around the world. So it's not just privacy, it's also digital. On AI, indeed, there are a lot of complaints that the AI Act is too expansive. And indeed, the EU now has to look at its implementing regulations to see whether they can be somewhat diluted.
Tony, we heard from the EU Trade Commissioner Sefcovic earlier this morning saying the EU must prepare well-balanced countermeasures against us. So in your view, the EU should actually be looking at unbalanced countermeasures in order to project strength. Is that correct?
Completely. Yes, asymmetric measures using the areas where the EU has an advantage, and services, of course, is one of them. There are lots of things that the EU could do that will hurt the United States more than the EU itself. Of course, that's the main point of this, is to reduce as much as possible the pain on EU citizens and maximize pain against the United States. But of course, this is a very sad place to end up. Let's be clear. We should not be in this place. For many, many decades, Republican and Democratic administrations were seeking to increase trade across the Atlantic, increase the bridges across the Atlantic, because that's how we create prosperity. This is a tax on consumers. It would be bad for both sides. And the other important point is there is a positive agenda that we could be entering into with regard to China. And I'm not just talking about reforming the WTO, but looking at being more serious about foreign subsidies. The EU has a new tool on foreign subsidies regulation, which is beginning to use. We can be cracking down on overcapacity. We can be working together more successfully on sanctions, on screening foreign direct investment. The list is very long. And also working together on writing together the rules on trade in these very specialized technical organizations around the world, which are very significant because they set the standards by which exporters have to respect, including on video surveillance and facial recognition and other important areas. So instead of dealing with these positive things, we are now in a vicious cycle of tit-for-tat retaliation potentially, which serves no one's interests.
Tony, in your mind, could the EU be using some of those tools in order to protect its industries that we know it wants carve-outs for, whether that's autos or pharma? Could there be maybe another solution using different tools than just asking the U.S. for carve-outs?
Well, as I said, I think what we should be doing is to say, look, the United States, we can be helpful to you in the areas that you are concerned about, particularly on China. Why don't we actually work together on the technologies of the future? AI is one of them, but there are others as well. Why don't we work together to ensure that our supply chains are indeed resilient? It's a major issue for both economies. We both woke up after COVID and realized that we're way too dependent on, well, China in particular, for not only rare earths on semiconductors and certain kinds of chemicals and so forth. So that's what we should be talking about. Instead of carve-outs for specific industries and so on, let's define a positive agenda.
Tony, before we let you go, on current trajectory, what does the US's trading relationship look like in 2 to 3 years' time with its major trading partners?
Well, unfortunately, I'm not very optimistic. I am rather puzzled. Obviously, it's been clear from what I've said at the trajectory of where we're going. And I say that because, as a former diplomat whose job was to promote the interests of the United States and of our exporters, I cannot see how this is going to benefit us in the United States and our exporters, who should be given a chance to compete fairly worldwide. And by that, I mean entering into agreements like the rest of the world to ensure that there's beneficial access of our exports all over. Now, I'll give you a couple examples. How is it possible in our interests that we have stepped aside from free trade in the TPP? Others have moved ahead in Asia through the CPTPP. And those exporters have beneficial access to a very large Asian market when we do not, relative to them. How is it of interest to us that the Canadians have a better access to the EU market in some instances than we do, because there's CETA, the Canadian free trade agreement with the EU, and we stepped aside from the TTIP agreement that I helped to negotiate, and we failed. And there are many other examples. So when we go away without leave, and other countries move ahead in signing these agreements, let's be clear, we lose out. We, our exporters, lose out. our exporters lose out. And we pay more for our inputs, which are often go into our exports. We become less competitive. So for me, I'm very puzzled. I do not see how this ends up supporting our ultimate objectives.
All right. Tony Gardner, former U.S. ambassador to the EU, a senior advisor at the Brunswick Group, and I believe executive advisor at Brookfield Asset Management as well. We thank you so much. Coming up on the program, we're going to talk about the reaction function to policy out of Washington as well. President Trump says the U.S. will send more Patriot air defense batteries to Ukraine to help defend against Russian attacks. More on the defense conversation next. Stick with us. This is Bloomberg.
Agreed on the number yet, but they're going to have some because they do need protection. But the European Union is paying for it. We're not paying anything for it, but we will send it. It'll be business for us, and we will send them Patriots, which they desperately need.
President Trump there saying the United States will send more Patriot air defense batteries to Ukraine to protect against Russia's ongoing airstrikes. It all comes as Axios reports that Donald Trump will also announce a new plan to arm Ukraine, possibly as soon as today. For more on the topic, we're joined by Keir Giles, senior consulting fellow over at Chatham House and author of, quote, Who Will Defend Europe and Russia's War on Everybody. Keir, a pleasure to have you on the program. From your perspective, can you just walk us through where you think this 180 in policy out of Washington came from?
Well, it's very hard to tell at the moment just what exactly the 180 is going to look like. We've heard various previews of what might possibly be happening later on today. And so often before, of course, those previews have been disappointed. There's been a wave of optimism after Donald Trump expresses frustration with Russia and promises to take action when actually it comes to nothing. But what we have at the moment is a combination of indicators that there might be more to it than the usual flash of irritation from Trump followed by no follow-up. There is this statement that there will be Patriots sold to Ukraine. Not quite clear who's supposed to be paying for them, whether it's NATO, the EU, individual countries. All sorts of ideas have been floated. And there's also the visit of NATO Secretary General to Washington, D.C., scheduled for today and tomorrow with no explicit purpose for it. So all of these indicators suggest that something might actually finally have changed in Donald Trump's policy towards Moscow. What lies behind that, of course, is far harder to divine. It could be that Trump's patience of being made to look foolish by President Putin has finally come to an end, but we'll have to see later on with this promised big announcement from Trump.
Yeah, Keir, this promised big announcement with Axios reporting that it could be something, quote, very aggressive. Do you see any room for the fact that maybe the Trump administration could be starting to offer offensive weapons to Ukraine?
Well, that certainly hasn't been mentioned yet. And we should also bear in mind that previously, when very aggressive action against Russia has been taken, it's ended up meaning no action whatsoever. So there's really a huge scope for what the Trump administration could decide to do to Russia, including, of course, supporting the proposed sanctions, the bill that's currently working its way through U.S. legislation to impose heavy sanctions on countries that buy Russian energy and therefore support the Russian war machine. But all of these things are currently in play. And as I say, there have been so many previous occasions where there have been big promises which haven't actually turned out to be very significant at all.
So, yes, Keir, we see if, of course, this change in tone from the president is matched by action on the ground. On the sanctions package, Keir, and good morning, how significant would that be if he does go down that route?
It would be a huge change, not just in U.S. policy, but also for the whole of the coalition back in Ukraine. Because this has been one of the key loopholes that's been identified a long time ago in trying to persuade Russia not to wage its war against Europe. The fact that so many countries around the world are actually supporting this war by buying Russian energy and pumping funds into the Russian economy so that it can keep going. That would be a major problem for Russia in a way that previous support to Ukraine has been more of an irritation than obviously a major problem that's stopping them waging the war. But, of course, there are other things in play as well. We have seen no indication that Trump is actually going to fully back this package, and without his support, it's unlikely to go anywhere. There's also still the question hanging of Russia's frozen assets abroad, where the interest from them has been used to support Ukraine, but actually confiscating assets and putting them towards the damage that Russia has done in waging its war still seems a long way off. So we have lots of promises in the air at the moment for things that could be done to try to change Russia's policy on Ukraine. But whether it will come true, of course, we still just don't know.
Well, Keir, this sanctions package, to follow up on Tom's question there, if it does indeed go through, adds a lot of pressure on China and India at a time when trade negotiations are still ongoing with the United States and New Delhi, as well as Beijing as well. How much kind of enforcement capability does the United States have on the likes of China or India if the sanctions package goes through?
Well, of course, this would also cause a lot of economic repercussions, not just with those countries that are primarily targeted because they're buying Russian oil, but around the world. And that, of course, has been one of the reasons why there has been hesitancy about exactly how much pressure you can exert on those major economies. And of course, we have to bear in mind that this is very much in Trump's House style of imposing random numbers of tariffs to try to influence the behavior of the countries, not necessarily with a particular outcome in mind, as we have in this particular case. But it might be that the design of this package is calculated to appeal to Trump because it's something that he's already doing all the time anyway. So again, we simply do not know at this point how it is going to play out and what Trump's attitude to this is going to be today.
Keir, how much of an advantage does Russia have right now, Vladimir Putin have right now in this conflict? How well positioned is Russia, particularly when it comes to its partnerships with North Korea and indeed the trade that it has with China?
This is one of the key questions that is unanswered about why Putin has not seized the opportunities that the United States under Trump has presented to him. Putin and those around him have concluded that it is better for Russia to push on at the moment, to continue pummeling Ukrainian cities, to try grinding forward on the front line at the cost of massive casualties, than accepting a ceasefire agreement and pocketing the gains that they have. Now, Russia may be right or wrong about that, but in terms of the support that they're receiving from their partners, the pattern that we've seen over the last couple of years is that those coalition partners that are backing Russia have been far more steadfast and far better at providing aid and assistance than those that were backing Ukraine. Russia has benefited from support from North Korean troops, from Iranian drones, from Chinese equipment and technology, where there's been the hesitancy on the other side from the countries that are backing Ukraine, which has seen them existing on a shoestring, and as we see at the moment, critically short of air defense assets in order to prevent those Russian missiles and drones from night after night pummeling those Ukrainian cities.
All right, Tom Giles, on that kind of sad note, I have to say, walking us through those dynamics between Washington, Moscow, and several other capitals around the world. Senior consulting fellow at Chatham House, we thank you so much. As we look to the week ahead, there's plenty going on, lots of inflation data on both sides of the Atlantic, plus bank earnings, specifically in the United States as well, all leading us to, of course, that G20 finance ministers meeting on Thursday, and on Friday, that's UMich consumer sentiment data. In the meantime, these markets, they continue to sell off. Although off of their lows, the outperformer this morning is, of course, the UK. Is that a risk gauge, though, as Valerie Tytel mentions? That remains up for debate today. However, green on the screen for London buyers, higher by about 0.2%. Your underperformer is the DAX. Does it for the opening trade. The Pulse is up next. This is Bloomberg.